Welcome to IFRS again. Now we'll take IFRS 1. What is IFRS 1? First time adoption of IFRS. That is those entities which will adopt IFRS for the first time. Which means before that they were following some other gaps, some other accounting rules, some other accounting principles which were not fully IFRS compliant, and now they want to present their financial statement as per IFRS. So you have to learn what will you do when an entity adopts IFRS for the first time. So in that case, we will learn how to convert their previous financial statement, which is based on other GAAP, into IFRS based financial statement. Okay, so it can be a massive exercise because a company may have in its financial statement hundreds of items. So what this standard does, it knows the practical difficulty in making the opening balance sheet fully IFRS compliant. So some mandatory exemptions are given and some voluntary exceptions are given. Mandatory exemptions means those which are compulsorily exempted. So you don't have to apply IFRS with respect to those items from retrospective effect. And optional exemption means either you can apply retrospective effect or you can apply prospective effect. So that is the IFRS 1 first time adoption of IFRS. The standard contains provisions for entities which will comply with IFRS for the first time. So this standard will be applicable in the life of a company only in the first year when it decides to prepare the financial statement as per IFRS. And this standard is basically a guideline how to move from your existing GAAP, existing set of standard to IFRS. So this will help you in smooth transition from any previous GAAP to IFRS. This transition should be facilitated when the existing standard, from the existing standard through a smooth process where cost of complying should not exceed the benefits also. So one should keep in mind the cost benefit constraint also when you apply IFRS. So that is why you will find in the next few pages they have given you relaxation that are called mandatory exemption and voluntary exceptions. So therefore you are given lot of relaxation in this standard. Everything need not be applied retrospectively. Okay, ideally what they are saying, your opening balance sheet should be as if you had been following IFRS from the beginning. That is the concept. But for some item there are some exemptions given. Now first we will see the scope paragraph in your book. Scope: the entity shall apply this IFRS in its first financial statement and each interim period report, if any, that it presents in accordance with IS 34, interim financial reporting for part of the period covered by its first IFRS financial statement. So this is applicable for first IFRS financial statement full 12 months. It is also applicable to interim period financial statement, because the moment you start applying IFRS, then you have to also apply it for the interim period also. So in the first interim period that you are going to prepare, this standard is applicable for that also. First we'll see the meaning of some critical terms, then we can understand the standard better. The date of transition to IFRS. The date of transition to IFRS means the beginning of the earliest comparative period for which an entity presents financial information under IFRS in its first IFRS financial statement. The beginning of the earliest comparative period for which an entity presents financial information under IFRS in its first IFRS financial statement. So how do you interpret this line? Suppose my first IFRS financial statement will end on 31st March 2021. So I have to give a comparative also. Comparative SOFP I have to give. That will be ending on 31st March 2020. But how to prepare this SOFP? For that, I have to prepare one opening SOFP. In order to prepare the closing SOFP of this year, comparative, you need to first prepare an opening SOFP as per IFRS. So this date, 1st April 19, that is beginning of the earliest comparative period presented. If I am preparing 3 comparatives, then although nobody will do that, but let us say a company prepares 3 comparatives. 31st March 2021, 31st March 2020, 31st March 2019. Can I give 2 more comparatives? Yes. Then the beginning would be 1/4/18. This will be called the date of transition to IFRS. And this is very important because what we are going to learn in the next few minutes will teach you how to prepare the SOFP as on the date of transition to IFRS. And once you get this SOFP, then you can prepare this, then you can prepare this, and then you can prepare this. Next is the meaning of deemed cost. What is deemed cost means? Assumed cost. An amount used as a surrogate for cost or depreciated cost at a given date. Now this concept of deemed cost will be required especially in items like property, plant and equipment. Because the standard will say you find out what will be the value of the property, plant, equipment on the date of transition as per IFRS. Now companies will say we had purchased this asset 20 years ago. Now I don't have so much of data. So they will give you an option which I am going to take later. And that amount becomes the deemed cost on the date of transition. Otherwise the time and cost involved will be too much to get the exact balance as per IFRS 16 or IAS 16. Subsequent depreciation, if it is tangible asset, or amortization, if it is intangible asset, assumes that the entity had initially recognized an asset or a liability at the given date and that its cost was equal to deemed cost. So this amount will be used for further accounting, whether it is depreciation or amortization. Now what about fair value? The standard will use this word fair value quite a lot. So fair value means the fair value as per IFRS 13. Same definition throughout all standard. What is the meaning of fair value? Price that would be received to sell an asset or price that would be paid to transfer a liability in an orderly transaction between market participants at the measurement date. So this discussion we already have completed in IFRS 13. So first you should read IFRS 13, then you should read this standard, it will be easier. Now next term is first IFRS financial statement. What is first IFRS financial statement? The first annual financial statement in which an entity adopts IFRS by an explicit and unreserved statement of compliance with IFRS. So that will be your first IFRS financial statement. Suppose an entity has decided to adopt IFRS for this financial year 2020-2021. So this financial statement, that is the year from which they have decided to adopt IFRS, the financial statement for that year, which contains an explicit and unreserved statement of compliance with IFRS, will be called its first IFRS financial statement. And first IFRS reporting period, the latest period covered by an entity's first IFRS financial statement. Again, see, suppose a company decides to adopt IFRS from 1st April 2021. This period, when you decide to adopt IFRS for the first time, will be called the first IFRS reporting period. And what is the meaning of first time adopter? An entity that presents its first IFRS financial statement. It is preparing IFRS financial statement for the first time. That is called first time adopter. And what do you mean by IFRS only? Very good question. What is IFRS? IFRS are standards and interpretations issued by International Accounting Standard Board. Standard and interpretations also. Those interpretations are called IFRIC or SIC. Okay. You will find there are two standards mentioned: International Financial Reporting Standard and International Accounting Standard. This in short is called IAS. The number system is up to 41. The prefix is IAS and afterwards the prefix is IFRS. IFRS 1, 2, 3 like this. Okay. Between 42 to 100 there is nothing, or after 42 IS series stops, IFRS series starts. Okay. Similarly, the interpretation given on IFRS is called IFRIC interpretations, and the interpretations given on International Accounting Standard, they are called SIC, Standing Interpretation Committee, and this is International Financial Reporting Interpretation Committee. Their interpretation is called IFRIC. So these four items together will be called IFRS. IAS is also IFRS. Okay. Next is opening IFRS statement of financial position. Opening IFRS statement of financial position, an entity statement of financial position at the date of transition to IFRS. So once again, let us revise. Suppose my first IFRS period ends on 31st March 2021. I want to give one comparative only, 31st March 2020, but then I have to give one more SOFP at the beginning of the earliest period. This SOFP will be called opening IFRS statement of financial position, because 1419 is the date of transition to IFRS. And then there is a last definition, previous gap. What is previous gap? Basis of accounting that a first time adopter used immediately before adopting IFRS. Now here this standard does not mention what is that previous gap. It can be anything. It can be anything. It can be US GAAP. And now suppose a company following US GAAP wants to switch to IFRS. So US GAAP will become previous GAAP. Or a company following Indian GAAP Okay, they want to now switch to IFRS. So then Indian GAAP will be previous GAAP. A company following Canadian GAAP. Canadian. They want to switch to IFRS. Then Canadian GAAP is the previous GAAP. UK also have their own set of standard. They may also want to move to IFRS. Or suppose you follow half of this, half of that. That is also previous GAAP. Anything which is not fully IFRS compliant, okay, where you have not given unreserved statement, okay, about the compliance of IFRS, all such accounting system, we will call it previous GAAP. Now our topic start. What this standard wants you to do, they want you to prepare one opening statement of financial position, because that will be my starting point. What is my starting point? First I have to prepare opening SOFP. On which date? Date of transition. How do you prepare? This opening SOFP should be as per IFRS. It means as if you had followed IFRS from the beginning. Okay. So that will pose a lot of challenges, because earlier GAAP was different. And now you have to convert all the figures under old GAAP, previous GAAP, to IFRS. So take one by one each item and see what would have been the balance in the IFRS. Okay. The desired output of the first time adoption exercise is opening SOFP. So the following paragraph lead towards preparing such statement of financial position. An entity shall, now see the guideline, the entity shall use the same accounting policy in its opening IFRS SOFP and throughout all period presented in its first IFRS financial statement. This accounting policy shall comply with each IFRS effective at the end of first IFRS reporting period. Now how will you interpret? I will use the same numbers. 31st March 21 is my first IFRS reporting period. I will give a comparative 31st March 2020. I will give one opening SOFP on 31st March 2019. Okay. First you check what are the accounting policy applicable on this date, not on 1/4/19, because after 1/4/19 there might have been some amendment in IFRS. Some new IFRS may have been issued. Some old IFRS may have been deleted. So don't look at which IFRS were applicable on 1/4/19. Which IFRS and provisions are applicable on this date. And using same accounting principle, you will prepare opening SOFP so that all periods are comparable, right? Because you can ask, if suppose there is a standard here, let us say there is a standard on leases on 1/4/19 and that standard has been amended and now there is another standard on leases here. Which standard I will follow on 1/4/19? The one which exists on 31st March 2021. Okay. So if you have to adopt something new, then adopt the latest. That is the logic. Now suppose the period ending 31st March 2021 is the first IFRS reporting period. An entity decides to adopt IFRS from this period and consequently prepares comparative financial and transition date statement of financial position. Hence, while preparing financial statement under IFRS 1, first reporting period, comparative and transition date, underline IFRS effective at the end should be applied for all transactions and balances. Okay. In order to confuse you, they might say that IFRS applicable on 1/4/19 will be applied on 1419 SOFP? You will say no. Now, 4 very important rule of this chapter on the screen. This is, you can say, one of the most important paragraphs of this chapter. You have followed old GAAP till now. Till 31st March 19, you have followed old GAAP, and from 1/4/19 you are transiting to new GAAP, that is IFRS. 4 things you will have to do on the date of transition. You have to recognize all assets and liability whose recognition is required by IFRS. Now, what does that mean? It means that there may be some asset or liability which were not required under previous GAAP, which were not required to be recognized under previous GAAP, but IFRS may require you to recognize them. I have written 1 or 2 examples for everything, but this list of example is just illustrative list. Like, for example, in many GAAPs, derivatives are not recorded on the balance sheet because derivatives are just contracts. And if it is like forward contract where there is no amount paid to enter into a contract, many companies think why there is need to disclose it as an asset or a liability. But IFRS 9 says derivatives are also financial asset or financial liabilities. Okay. So it may not be appearing in the old set of book, but then you may have to bring it into the books of account. So recognize all assets and liability whose recognition is required. Then next thing you have to do, derecognize. Derecognize those assets or liabilities which IFRS do not permit recognition. Okay. So in the previous GAAP, you might have recorded some goodwill, okay, which is not acquired in a business combination. You may have just created goodwill on your own old GAAP, because old GAAP can be anything, right? So goodwill you have recognized. But IFRS does not allow you to recognize goodwill unless goodwill is acquired in a business combination. So then you may have to write it off. IFRS does not have any such item like discount on issue of share. Then one more item you write down. Under some old GAAPs, proposed dividends were shown as liability in the balance sheet. Do you know that? IFRS says no. Dividend will be shown as a liability only after it is approved in the AGM or approved by the management in case of interim dividend. Till that time, it won't appear as a liability in the balance sheet. So, derecognize such items which are not required. Then reclassification. Again, the way items are classified in IFRS may be different from your previous GAAP. So we will have to reclassify. For example, under previous GAAP, you may be just writing one line, investment. But under IFRS, you have to write financial asset at FVTPL category, fair value through P&L account. Financial asset at FVT OCI, same investment but appearing under different names now. Financial asset at amortized cost. Is it right? Then under the old GAAP, you may not have something called non-current asset held for sale. So now you will find that there are some assets which are held for sale on the date of transition, but it was just put it under the head property, plant, equipment or fixed asset. But now you keep it in a separate heading called non-current asset held for sale. I am giving you few examples so that you can visualize that there will be a lot of shifting. One more example is earlier in many GAAP, investment property does not appear as a separate category. It appears as a part of either investment or property, plant and equipment. But in IFRS, there is a separate category called investment property. So you have to remove from PPE and show it as investment property. Okay. Then in case of IFRS, we have something called biological assets. In many previous gaps, many other gaps, there is no item called biological assets. So those you have to reclassify. And then one more thing, which is a big challenge, point number 4. Point number 3 may not be a challenge, only you have to just shift it from one pocket to another pocket. Point number 4 is a challenge. You have to measure, hold your breath, all assets and liabilities as per IFRS. As if you had followed IFRS for this item from the beginning. Okay. So in simple terms, you have to do retrospective working of that item and see today what would have been the balance of this item had I followed IFRS. And that is where you have lot of mandatory exemptions, voluntary exceptions, because applying paragraph 4 for each and every item of the balance sheet is a big difficult exercise. So here example I have written measurement. If you can, for example, investment property. Earlier model may be cost model, but you may shift to fair value model. Or another example could be share based payment, which in India they allow intrinsic value method. But in IFRS 2 you have to follow fair value method. So you have to recalculate the value of all outstanding share based payment at fair value. Okay. And then we will see many other such adjustments. Old gap, new gap. Amounts are changing. If the amounts are changing, where will you give the second effect? Where will you give the second effect? Suppose under old gap some financial asset was appearing at 10 lakh. And as per IFRS, if I take the fair value, it is only 9 lakh. So I have to bring down from 10 lakh to 9 lakh. That 1 lakh has to be adjusted somewhere. So they have said it will be adjusted in one of these two places. Depending upon what is that item, it may be either adjusted in retained earning. So in case if you get a problem in the exam, most probably what you do, you give the second effect in the retained earning. Is it right? Or depending upon some specific item, like OCI category item, revaluation gain or loss category item, you may give the effect in other category of equity. Okay. For those items whose values have to be changed, then you have to give the contra effect in retained earning or any other category of equity. Now mandatory exception to the retrospective application of IFRS. This itself can be a question, that what are the mandatory exceptions? So mandatory exceptions means you are not going to apply retrospective application of IFRS in the following areas. So it is prohibited, mandatory. You can't, even if you want, you can't do it. Right? And there are about 8 or 9 items under this, 8 items, which are subject to mandatory exemptions. First we'll read the list and then we'll discuss them individually. These are estimates, like provisions you have made. Whatever provision that is existing on the date of transition, carry forward as it is. Don't go to the past year and see what would have been the provision. Not allowed. Then derecognition of financial assets and liabilities. Hedge accounting, I will discuss one by one. Classification and measurement of financial assets and financial liabilities. NCI, impairment of financial asset, embedded derivative, and government loans. Okay. Now, what about the estimates? Estimates are approximation of an amount in the absence of a complete information. Okay. Estimates are approximation of an amount in the absence of complete information. So you can make estimate. In the previous gap also you must have made estimate. Now the standard, in order to simplify your transition process, to avoid unnecessary cost on you, because there may be so many estimates you must have made in the past, and if I ask you to do retrospective application, it may be time and cost, time consuming, and it will be costly exercise. Therefore they say items involving estimate at the date of transition should be consistent with the estimate that were made under previous gap. So just take the same figures for estimates like provisions. Okay. No hindsight means past information can be used for changing such estimate. Underline, because this can be part of your some case study. Management wants to change the estimate on the date of transition. Like this example can be a part of a case study. An estimate of provision for expense was made 673,521 on the date of transition. Okay, assuming the previous year ending date is 31st March and the date of transition is 1st April 19 to IFRS under previous gap. Later during 2021, which is my first IFRS based financial reporting period, it was ascertained that such provision amounts only to 573,641 and the rest was reversed. So what you will say, the provision under IFRS for the opening statement of financial position as on 1/4/19 should remain at 673,521 only. So when you will prepare the opening SOFP, this figure only you will take. Although you have known by the end of 31st March 2021 that my actual amount was 573,641. But while recording the amount in the date of transition SOFP, you will take this figure only. Okay. And the reversal should be made in the subsequent period as in the previous gap. So don't use this figure 573,641 even though you have known till 31st March 21. Now see how much gap is there, 2-year gap is there. So by the time you prepare this balance sheet, you know what is the actual amount of expense that you will incur. But then there is a note, no hindsight information can be used for changing such estimate. However, if an estimate has to be made due to the application of IFRS, if estimate has to be made due to application of IFRS, then such estimate should reflect the condition that prevailed on the date of transition to IFRS. Suppose you have not followed IAS 19, post-retirement benefit, that is also an estimation. And now on 31st March or 1st April 19, you will have to estimate what is my post-employment benefit liability. That can be done because that is the requirement of IFRS. Second mandatory exemption. Okay, second mandatory exemption means what you will not do from retrospective effect. If a first time adopter de-recognizes financial asset and liabilities in accordance with its previous gap, it shall not recognize those assets and liabilities in accordance with IFRS unless they qualify for recognition as a result of a later transaction or event. Simply put, those assets and liabilities, financial assets and liabilities, which you have de-recognized, do not recognize it again. Unless they meet some other criteria due to a later transaction or event. De-recognition principle should be applied prospectively from the date of transition to IFRS. Next is hedge accounting. Now for this you have to first know what is hedge accounting. Which standard deals with that? IFRS 9. How many types of hedges are there? 3. Fair value hedge, cash flow hedge, hedge of net investment in foreign operation, which is like cash flow hedge only. Now hedge accounting is a complicated set of accounting rules. It means you have an underlying asset, liability, firm commitment, forecasted transaction which you want to hedge, and for that you have to designate some derivative product as hedging instrument, and then a special set of hedge accounting is applied where you deviate from normal accounting rule. What about hedges which you have already entered into before the date of transition? Will you apply hedge accounting for such items? Generally the answer is prima facie no. Only some minor exception is mentioned here, we will discuss. So not very important. Only thing you will remember, for all past hedges, hedge accounting will not be applied. It will be applied only from prospective effect. The standard on financial instrument, that is IFRS 9, stipulates conditions and criteria to be met for designating a hedging item and hedging instrument in a hedge relationship. 3 important requirements are as under. Now as per this standard, what are the things you will keep in mind? 1. The transaction entered into prior to transition date shall not be retrospectively designated as hedges. Okay, so whatever you have done, don't go back and start applying hedge accounting. Where the transaction does not qualify for hedge accounting in accordance with IFRS 9, it shall not be reflected in the opening IFRS statement. Second thing, if there is something like hedge you are doing in the past, but it does not qualify for hedge accounting, then this will not be reflected in the opening IFRS. Okay, if some kind of hedge accounting you are following earlier under previous GAAP, but which does not meet the requirement of IFRS 9, then it will not be followed in the opening IFRS statement. Third is, if a net position had been designated as a hedged item under previous GAAP, an entity may apply hedge accounting principle in accordance with IFRS to an individual item within that net position on the date of transition. So net position maybe means one long position and one short position. So if there is a long and a short position simultaneously undertaken and it is designated as a hedged item under previous GAAP, then entity may apply hedge accounting principle to individual item within that net position. Instead of the whole net item treated as hedged item, the 2 individual item can be treated as hedged item and you can apply from the date of transition, not retrospectively. And now one more point tick mark or underline for any case study problem. In addition, as on transition date, an entity is required to measure all derivatives at fair value. As on transition date, all your opening derivative will be measured at fair value. Now even if that derivative does not exist on your previous GAAP balance sheet, and all deferred losses and gains reported under previous GAAP, if they were assets or liabilities, should be eliminated. So if any expense, any loss or gain you have deferred under previous GAAP, you might have not recognized derivative gain in the P&L account, okay, or loss in the P&L account. You might have deferred it directly under some equity head. Now clean your previous such deferred gain or loss item on derivative, and all derivative will appear at fair value on the date of transition. One more problem will arise in NCI. Under some gaps, NCI is measured using book value on the date of acquisition. For example, in India, there is an accounting standard 21. Okay. Indian GAAP, accounting standard 21. The calculation of non-controlling interest, which is also called minority interest, MI, minority interest, is based on net asset as per book value. But what IFRS says? IFRS says NCI will be based on fair value, either fair value based on the market price of the share or fair value of net assets. But in both cases it is fair value. Now suppose a subsidiary was acquired 10 years ago. Are we supposed to go to that 10-year ago situation and find out what would have been the fair value of NCI? Difficult task. One more thing is that it is not only difficult, it is very costly affair also. Because then there are valuation experts who will have to appointed, then they will try and find out the value. But management will be reluctant to pay unnecessary fees for such exercises. So therefore the standard says mandatory exemption. Okay. NCI, whatever amount is appearing, you continue with that. So certain requirement prescribed in the standard on consolidation and SFS are required to be applied prospectively from the transition date. Now, although retrospective would have been useful, considering time, cost, effort involved, following items can be given prospective effect. This relates to a statement of changes in equity, disclosing therein share of changes in owner's equity, also showing the share of non-controlling interest. So many provisions which we have learnt in IFRS 10, now they will be given prospective effect because of time and cost constraint. The following two requirement, if not done under previous GAAP, should not be done on retrospective basis. Disclose NCI even if the share of NCI were to show a deficit balance. Okay. So NCI can be shown as the negative figure also. And changes in ownership interest that do not result into loss of control or that leads to loss of control. So no retrospective effect for such item. Whatever is the amount appearing based on whatever previous GAAP you have followed, you do it. Now you have to remember IFRS 10. I am not going to discuss in detail today. There are two types of situation we have covered. Change in ownership interest which do not result into loss of control. Example, from 80% to 70%. Change in ownership interest that results into loss of control. Example, from 80 to 40%. And then we have taken few example how it affects my financial statement. If you have not done in the past, don't do it now from retrospective effect. This requirement of prospective application will not apply. Now there is one small point here, asterisk mark. where an entity applies the principles of accounting for business combination on a retrospective basis prior to transition date. Now, after a few paragraphs, you will see one heading called business combination. Okay. In case of business combination, it is an optional exemption. What is that optional exemption? I need to tell you now so that you can understand this paragraph. One option is do not apply retrospectively anything. Okay, simple. I will follow that in my company. You will also. Okay. Second is you can apply retrospectively. In retrospective, now let us say you have acquired a company 15 years ago. Are you going to do the retrospective application since 15 years? No. So they have given you one more relaxation here. If you want to apply retrospectively, choose a date. Let us say last 3 years only. And all the business combination which have taken place in the last 3 years only, on or after that cutoff date, only for those you will apply retrospective effect. That means in that case, these two adjustment can be given retrospective effect if the business combination accounting was done on retrospective basis. I am not sure how many companies will opt for retrospective application unless they want to increase their values. Okay. No, they can, because fair value method adds a lot of value to your balance sheet. You might recognize a lot of brand, trademark, which may not be recorded in the earlier gap. Okay. But anyway, our task is just to understand that this is an option in the chapter. In such cases, entities shall follow retrospective application principle for presenting information in the statement of changes in equity. Now next is tick mark this item, classification and measurement of financial assets and financial liabilities. Classification based on business purpose model and cash flow characteristics shall be done based on the facts and circumstances on the date of transition. Now first you tell me which standard talks about business model test, cash flow characteristic test. 32. Okay. 32 and 10, 32 and 9. That means if you want to classify an asset as FVTPL, FVTOCI or amortized cost, then the entity has to fulfill something called business model test and cash flow test. Okay. Now you have to apply the business model test and cash flow test not when the financial assets were acquired, but on the date of transition. Now because I am going to reclassify them on the date of transition, that you have learned 4 things: recognize, derecognize, reclassify, remeasure. Okay. So reclassification will be done on the date of transition. So I have to apply this business model test and cash flow test under the standards on financial instrument on the date of transition. Next point in the same line, fair value of a financial asset or financial liability to be carried at amortized cost shall be the amount determined on the date of transition. You want to show some financial asset or financial liability at amortized cost now, because under IFRS there is a category called amortized cost category. In your previous gap there may not be such classification. So what is your starting point? The fair value on the date of transition will become the amortized cost at the beginning. And then from this point onwards, you apply IFRS 9. Now, one more little complicated issue related to financial asset. Most of these adjustments that you will find here, most are related to one standard. Which one? IFRS 9. Because IFRS 9 is again a very new standard, totally revamped standard. So many countries, they still follow the old method of accounting of financial asset. Like in India, under Indian GAAP, there is investment accounting. So if they switch to IFRS, so many things they will have to revise. Right? Classification, measurement, impairment, etc. So impairment of financial asset. I'll read and I'll explain. At the date of transition to IFRS, an entity shall use reasonable and supportable information that is available without undue cost or effort to determine the credit risk at the date the financial instruments were initially recognized, or for the loan commitment and financial guarantee contracts, the date that the entity became a party to an irrevocable commitment, and compare that to the credit risk at the date of transition to IFRS. So first you have to see what is the credit risk on the date the instrument was initially recognized. Initially recognized means earlier. And you check the credit risk at the date of transition to IFRS. Okay. But subject to such information is available without undue cost or effort. If a financial asset was acquired 10-15 years ago, then getting its credit risk on that point of time may be difficult. If at the date of transition to IFRS, determining whether there has been a significant increase in credit risk since the initial recognition of a financial instrument would require undue cost or effort, an entity shall recognize a loss allowance to an amount equal to lifetime expected credit losses at each reporting date until that financial instrument is derecognized. Now, to understand this paragraph, you have to first understand IFRS 9. In IFRS 9, there are some provisions relating to impairment of financial asset. There are two types of loss allowance. Which are the two types of loss allowance? 12-month expected credit loss allowance, and second is lifetime expected credit loss allowance. If there is no significant increase in the credit risk, then we apply 12-month expected credit loss where the amount of impairment provision is very low or negligible. But if the risk has increased significantly, then this lifetime expected credit loss. What they have said in this paragraph, is it possible for you to check the credit risk at the time of recognition and on the date of transition without incurring undue cost and effort? If the answer is yes, then you will be able to make out whether the risk has increased significantly or not significantly. But suppose you are not able to identify whether the risk has increased significantly or not, then on the date of transition, you assume lifetime expected credit loss. To be on a safer side, you make a provision assuming a lifetime expected credit loss till that financial instrument will be derecognized. Okay. So management will find out some ways or means to check the credit risk. Otherwise, they will have to make a high provision for losses. What about embedded derivative? Now again remember IFRS 9. Most of these adjustments are based on IFRS 9 because that is the standard which is a game changer in the field of accountancy. Okay. Now embedded derivative, what you have learnt in IFRS 9, there is a host contract and there is a derivative. Subject to conditions given in IFRS 9, these two are separated. And derivative is accounted like a derivative. Host contract is accounted based on its classification. But you may have entered into such contract before the date of transition. Now again, considering the time, effort and cost involved, in bifurcating this hybrid contract into host and derivative, ignore all previous contracts and apply the standard IFRS 9, that is separating the derivative from the host contract based on reassessment on the date of transition. In fact, you can say just ignore the past transactions. Okay. Any new thing you want to do, you have to do it from the date of transition. And one more important adjustment is government loan. What about government loan? Sometimes government gives you loan at a lower interest rate. Okay. In IS 20 we have solved problems also on that. Like for example, market rate of interest may be 10%. Government may give you interest at the rate of 2%. So earlier what we used to do, suppose we have received 10 million as loan from the government, I will show 10 million only in my book as a loan from government, and I will recognize 2% of 10 million as interest. That is what you might be doing in the previous gap. But this IFRS 9, so once again the role of IFRS 9 is here. IFRS 9, IS 32 and of course IS 20, the main standard. Three standards are applicable for this. Now this IS 20 will require you to measure this grant at fair value, this liability at fair value. So you will discount it. Discount the future cash flow at 10%. But you are receiving interest at 2%. So the present value will be much lower than 10 million. Let us say 8 million only. For example, sake 8. So the difference between 10 and 8 million will be treated as government grant. And 8 million will be treated as government loan. 10 will be divided into two parts. 8 million as loan and 2 million as grant. Now, are you going to do this exercise for all such government loan outstanding on the date of transition? No. Whatever you have done, continue. But from this point onwards, you will have to apply this all standards, IFRS 9, IS 32, etc. So now you read, you will understand. If a first time adopter did not, under its previous gap, recognize and measure a government loan at a below market rate of interest on a basis consistent with the IFRS requirement, underline, it shall use its previous gap carrying amount of the loan at the date of transition to IFRS as the carrying amount of the loan in the opening IFRS statement of financial position. Same loan you carry forward. An entity shall apply IFRS 9 to the measurement of such loans after the date of transition to IFRS. If you take another such loan, then IFRS 9 will apply. You will calculate the fair value based on market rate of interest. Difference between actual loan and fair value of loan is government grant. Only government loan received after the date of transition shall be assessed to determine if it is liability or equity in accordance with IS 32. Okay, so these were the list of mandatory exemption. Now there are voluntary exemptions. Under that voluntary exemption, one paragraph they have separately given for business combination. Okay. And then other voluntary exemptions. Business combination is also a part of voluntary exemption only, but they have mentioned it separately in the standard. So what is the exemption here? To put it in simple words, you don't need to apply for business combination effect retrospectively, because one can understand how much time, cost, energy, effort will be spent. Companies might be doing business acquisition since last 15-20 years. So then you choose a cutoff date. Okay, you say this is my cutoff. My date of transition is 1/4/19. So I choose 1/4/17 as my cutoff date. And then once I choose this date, 1/4/17, then all business combination effected on or after this date, you have to give retrospective application. So your goodwill calculation, your NCI calculation, assets and liabilities calculation, deferred tax calculation, all will be given retrospective effect from a chosen date. Okay. And this will also affect your consolidated financial statement, because your NCI, goodwill, gain on bargain purchase, and also the carrying amount of assets and liabilities of subsidiary which you have to use in consolidation will also change. So this will affect consolidation also. This will affect IS 28 also. In case if you are having some associate, the standard says then for associate joint venture also the same cutoff date will be taken. Okay, same cutoff date will be used for associate, joint venture, subsidiary, business combination. So now you will read, you will understand. It's very easy. They may not ask you a practical question on this business combination. A first time adopter need not means may or may not apply the relevant principles in respect of business combination that took place prior to the transition date. If the entity opts to apply IFRS 3, suppose you really want to apply IFRS 3, following parameters will apply. So what will you do? The standard will not be applied selectively to some combination. Point number one, you can't do pick and choose exercise. Those which will benefit you, apply retrospectively. Those which may not be beneficial, don't apply. You can't do that. Then all business combination you have to apply retrospectively. Nevertheless, the entity can exercise a choice, underline, and select a cutoff date. Because this is very time consuming, costly exercise, as the consultants whom you will employ to help you to do this calculation, they will charge a huge FT fees. Okay, valuers charge a lot of fees. Recently I got my flat valued, so he came, he saw, he gave me a bill of 1 lakh rupees. Of course, he must have done a lot of exercise at the back. So, valuation just for a small flat of mine, if he charges 1 lakh rupees for valuation, imagine for a business how much fees they would charge. And select a cutoff date and apply uniformly and consistently the principles under IFRS 3 to business combination that occurred on and from the chosen cutoff date. On the screen at the top, so we have chosen 1/4/17. So then all business combination effected after or on or after this date, you have to apply business combination retrospectively and shall also apply IFRS 10 from the same date. And this principle implies that for business combination that effected before the date chosen by the entity, the standard need not be applied. So previous business combinations you can ignore. For example, we have written some dates for understanding. If a first time adopter elects to restate a business combination that occurred on or after 30th June 2020X6, it shall restate all business combinations that occurred between 30th June 20X6 and the date of transition to IFRS, and it should also apply IFRS 10 from 30th June. If under previous GAAP, goodwill is recognized as a deduction from equity, goodwill shall not be reinstated. So that is one instruction to you. If you have suppose deducted goodwill from equity reserve, or you may have written it off, then you don't need to reinstate it. The exemption for past business combination also applies to past acquisition of investment in associate, interest in joint venture, interest in joint operation, in which the activity of joint operation constitutes a business as defined in IFRS 3. So even these are exempted. Furthermore, the date selected for business combination will also equally apply for all such acquisition. That means even for associate, joint venture, joint operation, the same cutoff date would apply for applying equity method of accounting. Now, exemption from other IFRS. This is a long list of optional exemption. Okay. Now, I am not going to discuss 100% of this list, but I am going to cover majority of these items one by one. Okay. One of the important one is deemed cost, tick mark. Deemed cost, then leases, then you tick mark cumulative translation difference. These are easy ones which they can give you in the problem. Investment in associate, subsidiary, joint venture, assets and liabilities of associate, subsidiary, joint venture, compound financial instrument, designation of previously recognized financial instrument, fair value measurement of financial asset or financial liability at initial recognition, decommissioning liabilities including in the cost of property, plant and equipment, financial assets or intangible asset accounted for in accordance with IFRIC 12, that is called service concession arrangement, borrowing cost, transfer of asset from customer, extinguishing financial liabilities with equity instrument, severe hyperinflation, joint arrangement, stripping cost in the production phase of a surface mine. Not important. Don't waste your time on this. Don't waste on time on severe hyperinflation also. Then designation of contract to buy or sell, a non-financial item. Again, not very important. Revenue, foreign currency transaction and advance considerations. This is a, you can say right now, a complete list of optional exemptions. So some of the basic ones we will discuss. Okay. Share-based payment now. The first one I'll take share-based payment. Which standard deals with this? IFRS 2. Okay. The standard on share-based payment requires that share option granted, for example, to employees, and should be accounted for by applying fair value to the instrument on the grant date. Now again, understand the company may have issued lot of share-based payment plan prior to transition date. So what is the practical problem that will arise? If I have to apply from retrospective effect, I have to find out again the fair value of all such share-based payment outstanding. Okay. So what is your optional exemption here? A first-time adopter need not means may or may not apply IFRS 2 for options that are vested prior to the date of transition. However, disclosure requirement under IFRS 2 shall be given for such grants. Only those options which are outstanding, which are unvested, now they will be accounted under this IFRS 2, unvested options. Paragraph 17. Deemed cost. Surrogate for cost. This problem of deemed cost will arise for items like property, plant, equipment, investment property, intangible asset, and also what is called right of use asset under lease accounting. Okay. If you have purchased some asset 20 years ago, 15 years ago, finding the value under IS 16, the way IS 16 requires, may be a difficult task. So therefore there is an option also given here also. The standard provides two alternatives on the date of transition. One is, as usual, either the items of PP shall be determined by applying IS 16 retrospectively, if you can. It may not be very difficult also, in case if you have maintained proper records. Okay. And you have been just simply depreciating that item over a period of time. So same item you can use it. Okay. But in case if it is not possible to reach the balance required under IS 16, then a shortcut is allowed to determine the fair value of the asset and use such fair value as deemed cost on the date of transition. If you are not able to find out what would have been my balance under IS 16, then you simply find out the fair value of that asset on the date of transition and use that fair value as a deemed cost on the date of transition. In India, there is one more third option. What is third option in India? Whatever is your carrying amount on that day, based on whatever gap, that becomes your deemed cost. But here the third option is not here. Okay. Either it has to be as per IS 16 or fair value. Fair value determined on the date of transition becomes deemed cost. Fair value should be determined on the date of transition. A first time elector may elect to use a previous gap revaluation of an item of PPE. A first time adopter may elect to use previous gap revaluation. That means if earlier you are following revaluation model, previous gap revaluation of an item of PPE at or before the date of transition to IFRS is deemed cost at the date of revaluation if the revaluation was at the date of revaluation broadly comparable to fair value. If the asset is carried at revalued amount and it is broadly comparable to fair value, or cost or depreciated cost in accordance with IFRS adjusted to reflect, for example, changes in general or specific price index. So if this revaluation amount is close to fair value or is close to cost converted into fair value by applying a general or a specific price index, then the previously revalued figure can be deemed to be the fair value, and that becomes the deemed cost. To deem, previous revalued amount becomes deemed fair value on the date of transition, and as we discussed point B, the deemed fair value is your deemed cost on the date of transition. If an entity has done any event driven fair valuation at a previous date, what is event driven fair valuation? That means some important event have taken place, like say merger, demerger. Okay. If an entity has done any previously event driven fair valuation, fair value on that date can be taken as a deemed cost, and IS 16 should be applied from that date to determine the carrying amount on the date of transition. Now suppose your date of transition is 1st April 19. and you have done some event driven revaluation on 1/4/17. Some important corporate restructuring might have taken place and you have done revaluation on that date. Then take this figure, depreciate for 2 years, take this figure, depreciate it for 2 years, and then arrive at the deemed cost on the date of transition. This choice and disclosure prescription is also available for items like investment property, which are measured using cost model as per IS 40, right of use asset as per IFRS 16, and intangible asset as per IS 38. So the entire discussion is also applicable for these 3 more items. PP, so we can say this deemed cost provisions are applicable for PPE, intangible asset, investment property carried at cost, right of use asset under IFRS 16. And what is this provision? You can take the carrying amount as per IS 16, or you can take the fair value. Fair value should be done on transition date. Previous revaluation amount can be taken if it is close to fair value. If the fair valuation was done due to some event driven activity like corporate restructuring, etc., then take that fair value, depreciate it, and find the value on the date of transition. Now next is exploration and evaluation asset. This you will refer IFRS 6, exploration and evaluation asset, IFRS 6. Now IFRS 6 is very different from other standards, because in IFRS 6 we are allowing to capitalize expenditure incurred on exploration and evaluation, okay, of mineral gas and such other non-regenerative resources. I hope you remember something like this existed. But previous GAAP may not have followed the same accounting. So now you have a optional exemption here. Either you can do retrospective amendment here, or you can do prospective adjustment. A first time adopter may elect to measure oil and gas asset at the date of transition to IFRS on the following basis: exploration and evaluation asset at the amount determined under previous GAAP. So one option is you can continue with your previous accounting, no change. The second is the asset in the development or production phases at the amount determined for the cost center under the entity's previous GAAP. So both you can take as per previous GAAP. The entity shall test the exploration and evaluation asset for impairment. Only what they have asked you to do, if you are using the previous GAAP figure, then you will apply impairment testing on the date of transition. Both the standards you will apply for impairment testing, IFRS 6 also and IS 36 also. So what we will understand from this paragraph, you continue with your previous figure if you want. Only do the impairment testing. Next is exchange difference. Again, tick mark this important item for adjustment. They are not going to ask you question on exploration and evaluation asset, but exchange difference can come. Now, in accounting for the effect of foreign exchange rates, the cumulative translation difference for all foreign operation can be deemed to be zero at the date of transition to IFRS. So the standard says, suppose you have foreign operation. Suppose you have some carry forward foreign exchange difference which you have accumulated in some foreign currency translation reserve, etc. On the date of transition, make it 0. Of course, the second effect will go to retained earning. but you will not carry forward any translation difference in opening balance sheet with respect to foreign operations. The gain or loss on a subsequent disposal of any foreign operation shall exclude translation difference that arose before the date of transition to IFRS and shall include only later translation difference. Is it right? If this foreign operation is disposed of, so all exchange difference which were existing on the date of transition will not be transferred to P&L account. They have already been closed. But those exchange difference which will arise after the date of transition, they will be recognized. Is it right? Now we'll take a break.